There are moments in markets when the noise becomes so loud that most people stop seeing the system underneath it. They see one stock up, another stock down, one earnings report celebrated, another one punished, and they think the market is behaving randomly. I do not look at it that way. I look at markets the way I look at economies, debt cycles, credit systems, and human behavior. I ask what is changing, what is being rewarded, what is being punished, and what the second and third order consequences are likely to be. And right now, we are in one of those moments where the separation between strong businesses, overextended businesses, confused capital spending, and true long-term opportunity is becoming very clear. On the surface, it looks chaotic. AMD is showing strength again. The market is rewarding it because the spending cycle around artificial intelligence infrastructure is still powerful. The demand for computing, memory, chips, and the tools that support the new technology cycle is not slowing down. When large technology companies spend aggressively, that money does not disappear. It flows somewhere. It flows into companies that sell the essential picks and shovels. At the same time, other popular growth names are getting punished. SoFi fell hard. Robinhood fell hard. Coinbase fell. HIMS was down. MicroStrategy was weak. These are not small moves. These are the kind of moves that scare people who are trading emotion rather than studying fundamentals. But the mistake most investors make is that they see a falling stock price and immediately assume the business is broken. That is not how I think. A price move tells you what people feel in the moment. The financial statements tell you what the machine is actually doing. So when a stock falls hard after reporting numbers, I do not begin with the price. I begin with the income statement. I begin with revenue growth, expense growth, operating leverage, cash flow, customer growth, and whether management is building something that will compound or destroying value through uncontrolled spending. That is the discipline. And in this earnings period, that discipline matters more than ever because several major companies reported at the same time. Meta reported, Amazon reported, Google reported, Microsoft reported, Cheesecake Factory reported, and then there was one company that I believe many investors are misreading in the short term, but may look very different over the long term. That company is SoFi, but before getting there, I want to walk through the bigger pattern because the pattern is more important than any one ticker. The first lesson is Meta. Meta is still an extraordinary business. It has scale almost no company in history has ever had. It touches billions of people. It has one of the strongest advertising engines in the world. It has a founder who has repeatedly been underestimated and has repeatedly come through over long periods of time. But even great businesses can enter periods where the numbers begin sending warning signals. Meta reported very strong revenue growth. Revenue was up 33%, which is an impressive number for a company of that size. Among the largest technology companies, that kind of growth is rare. If you only looked at the revenue line, you might think everything was simple. But investing is not about one line. The problem is that cost of revenue was rising faster than revenue. Research and development spending was rising much faster than revenue. Total costs and expenses were rising faster than revenue. Income from operations grew, but not with the operating leverage you would want to see from a business that already has massive scale. That is important when a company grows revenue 33%, but expenses are growing around the same rate or faster. The business is not getting the kind of leverage that investors expect. You want a great business to show that each new dollar of revenue produces more profit over time. Not that the company must spend more and more aggressively just to maintain the growth rate. Meta also benefited from a one-time tax item that made net income and earnings per share look better than the underlying operating performance. That does not mean the numbers were bad, but it does mean you have to separate what is structural from what is temporary. That is how I would grade it. The revenue was strong, the business is still strong, but the expense structure is becoming a problem that makes the report good, not great. The second concern is users' daily active people were still enormous, but they declined from the prior quarter and missed what Wall Street expected. Meta explained part of that through disruptions related to Iran and WhatsApp restrictions in Russia. Those explanations may be valid, but the result still matters. In a platform business, user engagement is part of the foundation. You never want to see the foundation weakening even slightly while spending is accelerating aggressively. The third and most important issue is capital expenditure. Meta raised its spending expectations again. The number is now enormous. The range moved to roughly $125 billion to $145 billion for the year. That is not a minor adjustment. That is a major statement about where management believes the future is going. The question is not whether Meta should invest in artificial intelligence. Of course it should. The question is whether the size, speed, and uncertainty of the spending are justified by clear returns. This is where the market has a problem. With Amazon, investors can look at AWS. With Google, investors can look at Google Cloud. With Microsoft, investors can look at Azure. There are direct businesses receiving the capital and producing revenue growth that investors can measure. With Meta, the answer is less clear. The company is spending enormous sums, but investors are not being given a simple, clean, measurable line that says, this is where the capital is going. This is the revenue it is producing, and this is the margin structure that follows that creates uncertainty. And markets do not like uncertainty when the numbers become very large. This has happened before with Meta. Mark Zuckerberg has a pattern of making large, aggressive, uncomfortable investments. Sometimes the market punishes him badly before he adjusts. In 2022, Meta stock fell dramatically, and that pain eventually forced more discipline. He has come through before. But between the decision and the payoff, there can be a long and ugly period. That is why I do not look at Meta as broken. I look at it as a great business entering a dangerous spending phase. Over the long term, Zuckerberg may still be right, but in the short term, if the spending continues to rise without clearer proof of return, the stock could have more trouble. The market is telling management that the burden of proof has increased. That is a rational response. The next company is Amazon, and Amazon is a very different story. Amazon also spends heavily. It has always spent heavily. That is part of its culture. It builds infrastructure ahead of demand. It accepts lower short-term profitability when it believes it can create a much larger long-term ecosystem. But there is a key difference between Amazon and Meta right now. Amazon is showing the operating leverage. Net sales grew strongly. Cost of sales grew slower than revenue. Fulfillment costs grew slower. Sales and marketing grew much slower. General and administrative costs actually declined. Total operating expenses grew slower than net sales, and operating income grew much faster than revenue. That is what you want to see. When revenue rises and operating income rises faster, the business model is gaining leverage. The machine is becoming more efficient as it grows. That is one of the signs of a high-quality compounding business. Amazon also beat Wall Street expectations in a major way. Earnings per share were far above expectations. Revenue was ahead of expectations, but the most important part was AWS. AWS is the core profit engine. It is one of the most important cloud businesses in the world, and its growth accelerated meaningfully revenue. In the cloud segment rose 28% year over year, the fastest growth in more than 3 years. That matters because the market has been worried about cloud growth slowing. When Amazon shows AWS accelerating, while artificial intelligence demand is pulling more compute into the cloud, the story becomes much easier to understand. If Amazon increases capital spending, investors can see why. Customers need capacity. AWS is growing faster than expected. The demand is visible. That is why the market is more comfortable with Amazon spending aggressively than it is with Meta spending aggressively. Amazon also has another major engine that many people still underappreciate. Advertising. The advertising business grew rapidly with revenue around $17.24 billion and growth in the mid-20s. This is not a side project anymore. It is becoming one of Amazon's largest and most profitable businesses. Sponsored listings, marketplace data, consumer intent, and the connection between shopping and advertising create a very powerful system. Amazon has the transaction layer. It knows what people search for, what they compare, what they buy, what they abandon, and what they buy again. That is extraordinarily valuable. So when I look at Amazon, I see 3 things working together. I see the consumer commerce platform. I see AWS accelerating. I see advertising becoming a third giant. That is why Amazon is different from a company that simply spends because it hopes the future will arrive. Amazon spends into businesses where demand is already visible. That does not mean Amazon is risk-free. No business is. Capital spending can become excessive. Technology infrastructure costs can keep rising. Competition can intensify. But the story is clearer. The capital is connected to measurable businesses. That makes a big difference. Then there is Google. Google also delivered a very strong report. Revenue growth was strong for a mature company of that size. Cost of revenue grew slower than revenue. Total costs and expenses grew slower than revenue. Income from operations grew faster than revenue. That is operating leverage. And Google Cloud was the key. Google Cloud revenue grew about 63% year over year. That is an extraordinary number. The cloud business crossed a very large quarterly revenue level, and the growth rate showed that Google is no longer just an advertising company trying to catch up in cloud. It is becoming a major cloud and artificial intelligence infrastructure player. That is why Google can also get away with large capital spending. If Google says it needs to spend much more, Investors can point to the cloud line and say, I see the reason Google Cloud is accelerating. Customers are demanding capacity. The business is scaling. This is why Google and Amazon were rewarded while Meta was questioned. The market is not simply against spending. The market is against spending that does not have a visible enough return path. That distinction is important. Google's quarter looked excellent, but valuation also matters. A great company can become less attractive if the stock has already moved too far. There are times to buy, times to hold, and times to reduce. A disciplined investor understands that the quality of the company and the attractiveness of the stock are not the same thing. Google at much lower prices was a clear opportunity. After a strong move, the margin of safety changes. That does not mean the business is worse. It means the price has changed. Price matters because future returns are a function of both business performance and what you pay. Microsoft is next. Microsoft delivered a strong report, though not as strong as Google. In my view, revenue grew well. Operating income grew faster than revenue. Net income and earnings per share also grew faster than revenue. That is good. But cost of revenue grew faster than revenue, which matters. It means the company is not getting perfect leverage across the whole model. The reason the report still works is that Microsoft controlled research and development, sales and marketing, and general and administrative costs better than some others. So Microsoft still showed leverage at the operating income level. The issue is Azure. Azure is still growing at a very high rate, but it did not show the same acceleration that Amazon and Google showed in their cloud businesses. It remains strong, but the market wants to know whether the enormous capital spending is leading to accelerating growth. Microsoft also called for major capital spending, partly because memory costs and infrastructure needs are rising. That brings us to a very important point that sits underneath all these reports. When Amazon, Google, Meta, and Microsoft increase capital spending, somebody receives that money. That somebody is not a vague idea. It is NVIDIA, it is AMD, it is Micron, it is companies that provide the chips, accelerators, memory, and systems that power the artificial intelligence build-out. This is one of the most important second-order consequences in the market right now. Investors argue about whether the big technology companies are spending too much. That debate matters for those companies. But for the suppliers, the simple reality is that the spending is happening. When the largest technology companies in the world say they are going to spend more on AI infrastructure, the near-term beneficiaries are the companies selling the infrastructure. That is why AMD can continue to show strength. That is why NVIDIA remains positioned well. That is why Micron matters more than many investors understand. Artificial intelligence is not just about computing. It is also about memory. If systems become more complex, if models need more context, if agents and data centers require faster throughput, memory becomes a bottleneck. When memory becomes a bottleneck, companies like Micron can benefit. So the strange part of this market is that the same capital spending that creates pressure on Meta, Microsoft, Amazon, and Google earnings can simultaneously create strength for NVIDIA, AMD, and Micron. That is how systems work. One company's expense is another company's revenue. One company's margin pressure is another company's growth cycle. You have to look across the whole chain. Now let me talk about Cheesecake Factory, because it is a very different kind of company. There is something refreshing about a business that does not need to justify tens or hundreds of billions of dollars in artificial intelligence capital spending. People eat food, they go to restaurants, they pay for meals, the economics are simpler. Cheesecake Factory reported a solid quarter. Revenue increased. Food and beverage costs improved as a percentage of revenue, labor expense improved as a percentage of revenue, some operating costs were higher, but the overall business showed resilience. Income from operations improved. Net income looked much stronger, partly because of the absence of a prior year debt extinguishment loss. This is not a company growing at technology rates. It is not supposed to. It is a different kind of asset. It has brands, it has a restaurant base, it has concepts like North Italia and Flower Child that can expand over many years. It has a core Cheesecake Factory brand that remains a powerful cash machine. It also pays dividends, which create optionality for the investor. The lesson here is that not every good investment must be a hyper-growth technology company. Some investments compound through steady execution, brand strength, disciplined expansion, and cash return to shareholders in a portfolio that can matter. You do not want everything you own to depend on the same narrative. You do not want every business to require the same input. You do not want every company to be valued on the same expectations. That is why I think about diversification not only by sector, but by economic driver. Some companies benefit from artificial intelligence spending, some are pressured by it, some are outside it. Some pay dividends, some reinvest aggressively, some are cyclical, some are more stable. A well-built portfolio understands those differences. Now we come to the company that many people are currently misreading, SoFi. The stock fell hard. That is what people saw. But the numbers told a more interesting story. Total interest income increased strongly. Interest expense rose much less. Net interest income grew meaningfully. Loan origination, sales, securitizations, and servicing increased dramatically. Loan platform fees were up. Total non-interest income rose. Total net revenue grew strongly. Income before taxes rose very sharply. Net income rose sharply. Earnings per share doubled. Those are not weak numbers. Those are the kind of numbers that make me separate short-term price action from long-term business progress. SoFi's members grew to about 14.7 million from about 10.9 million. That is a major increase. The customer base is still far from mature. A company like this, if it executes properly over a long enough period, can reach much larger membership numbers. The Galileo technology platform also showed a reversal after declines in platform accounts. That matters because investors have been concerned about that segment. A stabilization or rebound there could be an important signal. So when I look at SoFi, I ask a simple question. Is this a stock that is down because the market is correctly identifying a broken business? Or is it down because the market is reacting emotionally to near-term concerns while the business continues to build scale? The answer matters. SoFi is not risk-free. I want to be very clear about that. It operates in banking and financial services. Banking-related businesses always carry special risks. Balance sheet risk, credit risk, regulatory risk, liquidity risk, the risk of mistakes with loans, the risk of overextension. Any company connected to banking must be treated with respect. That is why position sizing matters. You do not take a business with banking risk and act as though it cannot go wrong. But risk is not the same as bad. Risk means you must understand the machine, size the position properly, and demand a sufficient reward for the uncertainty. In SoFi's case, the opportunity is that it is trying to build a modern financial platform for a generation that does not want the old banking experience. It wants checking, savings, lending, investing, credit, crypto, stocks, financial products, and a user experience that feels more like a technology company than a legacy bank. That is a powerful direction if executed. Well, legacy banks have scale, trust, deposits, and long relationships. They are not weak competitors, but many of them are slow. They are often burdened by old systems, old branches, old customer habits, and old technology. SoFi is attacking a different part of the market with a different model. If it continues to grow members, expand products, control risk, and increase profitability, then the market may eventually stop treating it like a speculative fintech and start treating it like a serious financial institution with technology economics. That transition can create large returns. This is why some investors compare the opportunity to what Palantir once looked like before the market accepted the story. Not because the businesses are the same, they are not. Palantir is a data and software company. SoFi is a financial platform. But the pattern may rhyme: a misunderstood company, a strong founder or management team, a long period of skepticism. Improving numbers beneath the surface, a stock that gets punished even while the business develops. Then, if execution continues, a re-rating. That is the kind of setup that can create outsized returns. But again, there is a difference between a good story and a good investment. The numbers must keep confirming the thesis. I would not own a company like SoFi simply because it sounds exciting. I would own it only if the operating data continues to show member growth, revenue growth, margin improvement, risk control, and expanding product adoption. That is what matters when I think in systems. I do not ask whether I like a stock. I ask what has to be true for the stock to work, for SoFi to become a much larger company. It needs several things to happen. It needs to keep adding members. It needs those members to adopt more products over time. It needs to generate more revenue per customer without taking irresponsible balance sheet risk. It needs to keep credit losses under control. It needs the Galileo and technology platform side to matter. Again, it needs to prove that it can become profitable in a durable way, not just in a one-quarter way. It needs to show that it can compete with large banks and fintech companies without spending irrationally. If those things happen, the upside can be large. If they do not happen, the stock can remain volatile or disappoint. That is the reality. The great mistake people make with growth stocks is that they want certainty before the price moves. But by the time certainty arrives, the opportunity is often much smaller. The other mistake is that they confuse uncertainty with opportunity and buy anything that falls. Neither approach is intelligent. The intelligent approach is to map the probabilities. If the business keeps executing, what can it become? If the environment worsens, what can go wrong? If the market remains skeptical, can the company still fund itself and keep growing? If management makes mistakes, how severe are the consequences? If the thesis works, is the reward large enough to justify the risk? That is how I would think about SoFi, not emotionally, not because it fell 15%, not because someone online said it is the next Palantir, not because the chart looks exciting, because the financial statements show a business that may be compounding underneath the volatility. That is the kind of situation worth studying. Now step back and look at the entire earnings picture. Meta is growing fast, but its spending is becoming a problem and the return path is less clear. Amazon is spending heavily, but AWS and advertising make the investment case much clearer. Google is spending heavily, but Google Cloud is accelerating at a level that gives investors a reason to accept the CapEx. Microsoft is still strong, but Azure needs to show clearer acceleration to justify the scale of spending. Cheesecake Factory shows that steady, non-AI businesses can still produce attractive results when they execute. And SoFi shows that sometimes the stock market punishes a company even while the underlying business is improving. This is why earnings season is so valuable. It strips away narratives. Before earnings, people can tell stories. After earnings, the numbers either support the stories or they do not. I have learned over many decades that markets are not perfectly rational day to day, but over long periods they follow earnings, cash flows, margins, and the return on capital. That is the gravity. Stock prices can float above or below that gravity for a while. They can overshoot, they can undershoot, they can become manic or depressed. But eventually, business reality matters. So when you see AMD rising, ask why. When you see SoFi falling, ask whether the business is actually weakening. When you see Meta punished, ask whether the spending is producing measurable leverage. When you see Amazon rewarded, ask whether the cloud and advertising engines justify the price. When you see Google strong, ask whether the future returns still compensate you after the stock has already moved. When you see Microsoft spending, ask whether Azure is accelerating enough. When you see Cheesecake Factory, ask whether stability, dividends, and expansion deserve more respect than the market gives them. This is how you think like an investor rather than a spectator. You do not simply ask, did the stock go up or down? You ask, did the underlying machine become better or worse? That is the central question. And right now, the market is telling us something important about artificial intelligence. It is telling us that the spending cycle is still alive. The largest companies are not pulling back. If anything, they are increasing their commitments. That means the infrastructure beneficiaries may remain strong for longer than many people expected. But it is also telling us that investors are beginning to separate the companies that spend with visible returns from the companies that spend with unclear returns. That separation is healthy. It means the market is no longer blindly rewarding every AI story. It is beginning to ask, where is the money going? And what return does it produce? That is the right question. In every major technology cycle, there are winners and losers. There are companies that provide the infrastructure. There are companies that build products on top of it. There are companies that overbuild. There are companies that spend too much. There are companies that use the cycle to strengthen their moats. And there are companies that burn capital chasing a story. The investor's job is not to cheer for the story. The investor's job is to identify which machines convert capital into durable future cash flows. That is why I pay attention to operating leverage. Revenue growth is important, but revenue growth without margin discipline can destroy value. Revenue growth with rising leverage can create enormous value. That is the difference between good growth and expensive growth. Meta has good growth, but the expense trajectory raises questions. Amazon has good growth and clearer leverage. Google has strong growth and very clear cloud acceleration. Microsoft has strong growth but less obvious acceleration in Azure than the others. SoFi has high growth with a business model that still carries financial system risk, but the progress is visible. Cheesecake Factory has slower growth but more stable mechanics. These are different animals. You should not analyze them with the same lens. That is one of the biggest mistakes investors make. They apply one framework to everything. A restaurant is not a cloud business. A bank is not a social media platform. A semiconductor company is not an advertising business. A company spending $145 billion on CapEx must justify that spending differently from a restaurant opening new units. A financial platform must be judged by growth, risk management, deposits, credit quality, and product expansion. A cloud provider must be judged by capacity demand, margins, infrastructure spending, and customer growth. A social media company must be judged by engagement, monetization, spending discipline, and whether its AI investment creates measurable returns. The principle is the same, but the metrics change. That is what professional investors understand and most retail investors miss. So what do I do with all of this? I stay focused on the long term, but I do not ignore short-term signals. That may sound contradictory, but it is not. Long-term investing does not mean ignoring new information. It means incorporating new information into a long-term decision framework. If Meta continues to raise capex and cannot explain the returns, that changes the risk profile. If Amazon SaaS continues to accelerate, that strengthens the thesis. If Google Cloud keeps growing at extraordinary rates, that supports the spending cycle. If Microsoft's Azure stalls relative to peers, that matters. If SoFi continues to grow members and earnings while the stock is punished, that may create opportunity. If Cheesecake continues expanding concepts and paying dividends, that may remain an attractive compounding asset. This is the job. You do not marry your opinions. You stress test them, you update them as the facts change. The danger is when investors become attached to a stock the way people become attached to an identity. They defend it even when the numbers deteriorate, or they abandon it when the price falls, even when the numbers improve. Both are emotional errors. You need principles. One principle is that expenses must eventually produce returns. Another principle is that growth must be judged against the capital required to create it. Another principle is that risk is not something to avoid entirely, but something to price properly. Another principle is that the best long-term opportunities often look uncomfortable before they become obvious. Another principle is that short-term volatility is not the same as permanent impairment. These principles keep you from being pushed around by the market's mood, and that matters because the market's mood changes constantly. Today it loves AMD, today it punishes SoFi, today it questions Meta, today it rewards Amazon and Google. But the mood is not the truth. The truth is, in the compounding machine, I believe the next several years will continue to reward companies connected to the AI infrastructure build-out, especially when those companies are receiving the capital that the largest tech companies are spending. That includes the chip and memory side of the ecosystem, but I also believe investors need to be careful with the companies doing the spending. Some of them will earn excellent returns on that investment. Some may spend too much before the returns become clear. The difference will matter at the same time. I believe there are still opportunities in companies outside the most obvious AI trade. SoFi may be one of them if it continues to execute. Cheesecake Factory may be one of them if it keeps expanding and generating cash. The point is not that every opportunity must look the same. The point is that the best opportunities are where the market's current perception is worse than the company's long-term reality. That gap is where investing lives. Sometimes the gap is created by fear, sometimes by confusion, sometimes by complexity, sometimes by temporary expense pressure, sometimes by investors focusing on one quarter instead of the system. Your job is to identify the gap without fooling yourself. That requires patience. It requires humility. It requires the willingness to be wrong. It requires position sizing that lets you survive being early. And it requires studying the numbers rather than reacting to headlines. That is what I would tell any investor watching a market like this. Do not be hypnotized by the daily price moves. Do not assume a stock is a bad business because it fell. Do not assume a stock is a great business because it rose. Look at the machine. Look at the revenue. Look at the costs. Look at the operating leverage. Look at the capital spending. Look at the balance sheet. Look at the customer growth. Look at whether the business is becoming more powerful or less powerful, and then ask whether the price you are paying gives you enough room for the inevitable mistakes and uncertainty. That is the whole game in this moment. The market is separating stories from systems. Meta still has the story, but the system needs more discipline. Amazon has a system the market can understand. Google has a cloud acceleration story backed by numbers. Microsoft remains powerful, but the acceleration question is real. Cheesecake has a simpler cash flow story, and SoFi may be a misunderstood compounding platform with real risk and real upside. That is why SoFi interests me. Not because it is easy, not because the stock is calm, not because the market agrees. It interests me because the market reaction and the business progress appear to be moving in different directions. When that happens, and when the underlying data supports the business, a serious investor should pay attention. That does not mean bet everything. That does not mean ignore risk. It means study it deeply, because every great long-term investment begins as a question most people are not willing to sit with long enough. Could this company become much larger than the market currently believes? Could the current fear be temporary while the business progress is structural? Could the volatility be the price of admission? Could the reward justify the risk? Those are the right questions. And in investing, the right questions are worth far more than confident answers given too early. So I will keep watching the numbers. I will keep watching where the capital flows. I will keep watching whether the companies spending on AI are getting returns. I will keep watching whether the companies receiving that spending are translating it into earnings. I will keep watching whether SoFi keeps growing members, revenue, net income, and platform strength. And I will keep thinking in probabilities rather than predictions. Because markets are not won by people who shout the loudest, they are won by people who can stay rational when the crowd is emotional, who can distinguish a temporary price move from a permanent business change, and who can hold a clear long-term thesis while constantly testing it against reality. That is how real wealth is built, not by chasing every stock that rises, not by abandoning every stock that falls, but by understanding the machine before the crowd understands the machine. And when you find a machine that is improving while the crowd is still afraid, you may have found the beginning of something very important.